Hey everyone, welcome back to season 2, episode 6. Today I sit down with Anne Mino at Live Oak Bank. We're going to have an SBA lending masterclass. Looking forward to the conversation today, and all of that is coming up next.
Welcome to the Storage Rebellion Show. Real conversations about building great storage businesses and becoming the kind of person capable of sustaining real freedom. Here's your host, Chris Michaels.
Hey everyone, welcome back to the Storage Rebellion Show. I'm excited to have Anne Mino from Live Oak Bank joining us today. Anne, how are you?
I'm great, thank you. How are you?
I'm doing fantastic. I appreciate you making time to join us on the podcast. I believe this is your first appearance on the podcast. However, you have been very active within the Storage Rebellion. You've been to a bunch of our events and our live calls and summits. And so I'm excited to sit down and have not necessarily listen to a presentation and slides, but rather have a conversation. And I know we're going to go deep into SBA and lending and all of that stuff. But before we do, give us a quick background on yourself.
Sure. So I work for Live Oak Banks. We are a niche lender, and I have a team of 7 lenders that only do self-storage. So we eat, sleep, and breathe self-storage. If you call us, we know what we're talking about. We know what your margin should be. We know what we're looking for, metrics, demographic metrics, all those sorts of things. You're not going to have to teach us about storage. And we have a fantastic portfolio, 1.7 billion strong. Very, very, very low default rate, like less than 0.5%. And me personally, I'm a senior loan officer on the team. I've been doing self-storage lending specifically for about 7 years, and I've been with the bank for about 14 years. So it's been a long, beautiful career with the bank, and I've seen it through. I was employee 124, and now we're all the way at well over 1,000 employees. So it's been a really
Wow.
fun ride.
Yeah. And you guys are based in North Carolina, correct?
We are in Wilmington, North Carolina. We're a branch bank, so we're all here. And our business model is to travel to see our customers at their place of business. So I am on the road a lot. And
Yeah.
before the loan closes, we like to meet our customers in person and we like to walk the property with them. So if they live in a different place than the property, sometimes we'll do both. We'll fly to the facility and we'll fly to meet with them.
Oh, awesome.
It's
Yeah,
great.
very
We
cool. And
consider ourselves a relationship bank, and we mean that. We're
yeah,
gonna build a relationship with you, and most of our referrals are internal referrals.
yeah. No, I love that. And I know you also invest in self-storage yourself too. What kind of turned you on to self-storage to begin with?
It's if I'm being honest, it was a job that was open at the time I was applying for my very first lending job,
Mhm.
and I feel like I got really lucky because I got put on a great team with great people in a great
Yeah.
space. We survived COVID. I think I could probably say this better than any industry that the bank lends to. Our customers, the bank called every single one of their customers during COVID and said, "Do you need help?" And most of our storage customers we said, "Well, we'll take help, but we don't necessarily need help. We're not having trouble making our payments." So I feel like I got really lucky. This is such a strong industry, and there's a lot of 3 to 5 mile radiuses in the United States. So for people that are kind of naysaying on self-storage, I'm here to tell you, like, our production is growing every single year, year over year. Right now, we've almost doubled what we did last year, just halfway through the
Wow.
year. So pretty remarkable. So I feel like I
Yeah.
got really lucky, but I fell into it is the answer.
Yeah, no, that's pretty cool. And as far as you've been in it now for a
Almost
little
7
over a
years.
decade, it sounds. What have you seen as far as the trends within storage?
That's a great question. Probably this is not gonna be news to anybody. I think the largest trend is that it's no longer a secret. Storage is out there. We've got the big
Yeah.
players, capital markets coming. There's a lot of money being spent in self-storage. There are a lot of cash buyers. There's a lot of activity that wasn't there even 5 years ago.
Mhm.
We've been privy to a very volatile interest rate environment. We went to some of the lowest interest rates that the country's seen in, I don't know, golly, 20 years, to a spike, which actually was just a normalization. It really wasn't. We're not in a high interest rate environment. We're just in a higher interest rate environment.
Yeah.
So it's been interesting to see how storage has weathered that rate volatility. It's done well. It's not foolproof just like anything else, but we're pretty proud of our portfolio. I think it is a business you have to manage. The ideal is that you own a portfolio and it kind of runs itself with a little bit of oversight. But when you're first starting out, you do need to pay attention. It's always going to be passive income, but I do think that it's important to note that you do need to pay attention to it.
Yeah. No, you bring up a good point too, because we certainly see it. I mean, being in the education space, we see it all the time where a lot of folks get into storage thinking that it's 100% passive. All we need to do is own a facility, get it up and running, and then we can kind of forget about it. And I think a lot of people forget to treat it like a business. It is something that you do need to manage and take care of. And it's like anything, right? Like you want to, if you really want to create incredible wealth, you want to grow financially, you can't just buy something and leave it alone and just think
That's
it's,
right.
you know what I mean? We do
Exactly.
see it
Exactly right.
often. Yeah. And, you know, and you probably see this all the time too, but the folks who are being really, really successful in this space are treating it like a business. They know their business inside and out, and they're always looking for new ways to optimize it. But I also want to touch on, so you're doing SBA loans, and I think this is a topic we were talking about earlier. It's a topic that not a lot of people have a whole bunch of information on. So I'd love to dive in, maybe even do a mini masterclass on this. But give us some of the highlights of why people should consider going with an SBA to begin with, and at what point in their journey should they be looking at it?
So we offer both SBA and conventional loans. So I can do both. If you call me, I can do
Mhm.
either one. Most conventional lenders want you to have experience. So the number one differentiator is I can do a loan for somebody that has no experience at all whatsoever, maybe a carpenter or a CPA or has no, truly nothing to do with self-storage. I can still do that loan for them. They're still going to get the same rate as the person that already owns 3 facilities, that kind of
Mm.
thing. So that's probably the number one thing. Number two thing is the difference in your equity injection, which is how much cash you have to bring to the table at closing. So cash at closing is really important. It has to come in the form of cash. So if you have assets tied up in, say, residential real estate, you can't pledge that asset as your equity injection. It's coming to us in the form of cash. If you want your cash that you have to go the absolute furthest, you're going to fall in love with the SBA because it has a 10% equity injection versus a conventional loan that's got 30 to 35%. So instead of putting, let's say you only have a $300,000, that could be $3 million facilities, or it could be one $3 million facility. And or it could be, if you were doing a conventional loan, that would be your 30% on $1 million facility. So do I want to own $3 million facilities? Do I want to own a $3 million facility,
Right.
or none of the above? I'm going to go conventional and set that money aside. And
Yeah.
think about it in these terms, or at least this is how I'm thinking about it as I enter self-storage ownership, because I'm hoping to buy my first facility this year that I want to run and operate myself, not just be a passive investor. Thing.
Go
So
ahead.
this is how I think about it, because I'm risk averse. So I don't want all my eggs in one basket. I would
Mhm.
rather own 3, let's say, call them $1 million facilities with my $300,000 of capital, just in case one doesn't perform as well as the other one. So that interests me more than even buying like one facility for 3 million. I'd rather have 3 for less, so that I'm diversifying my risk. For
Mhm.
my comfort level, I think that's a great strategy. When you are new to storage, you're going to be learning, you're going to make mistakes. No matter how many of these podcasts you listen to, you can attest to this, Chris. There's still going to be some bumps along the way because nothing's perfect and nobody can tell you what the future holds. So the SBA all day long for equity, as far as the minimum amount that you can put in. Engaging with a lender as early as possible is my recommendation. You want to build a relationship. It is a relationship business. I'm going to take care of you. If you're established with me and you've come from Storage Rebellion, and I may already know you from that, I may not, but as soon as you tell me that you've gotten some education, you've invested in yourself in this industry, you're probably going to go to the top of my leaderboard, my lead stack. It's important for your lender to know you on a personal level. Numbers are great. I want to see what your cash is. I want to see what your income is. I want to see that you have the ability to borrow money and pay it back. But I also want to see, like, who are you? How much have you invested? Are you and your partner sitting down every single night after work and looking at deals? Like, I love talking to people like that. Like, they're excited about storage. They're not
Mhm.
just like have a hope and a prayer that something's going to
Yeah.
fall in their lap. So for a couple reasons, it's a good idea to engage with your lender early. If you get pre-qualified with a lender, they're going to give you a nice little letter that is going to make you look better to a broker and more serious. 'Cause a lot of
Mm,
times brokers, if they get 10 offers, they're trying to weed through those and figure out like who is a
yeah,
legit offer and who's going to waste my time or who has not
yeah,
got, not to be fast, but that is, that's what the brokers are thinking. Who's going to close
yeah,
this
for
loan?
sure.
You
Yeah,
might accept a lower offer from somebody that they know is real.
right. Yep. Yeah, we just had David Perleshi on. We were talking all about this, and you had mentioned, remind me how much cash somebody should be bringing when they're doing an SBA.
So the minimum equity injection is 10% on the
Okay.
SBA 7A program. If we go 504, which I don't normally do that program for someone's first loan,
Mhm.
that's 15%. So you'll hear both. You'll hear 10 and 15. Sometimes you're like, what's the difference? It's loan program. And then it's based on debt service coverage of the facility. So we're not expecting you personally to pay this debt back. We are looking at the financials of the facility to pay this back. So we can only do that high leverage if the projections look such that the business is going to be able to support that much debt.
Sure.
Well, if it doesn't, that's where we start to play with, hey, let's maybe you need to bring in, 12% instead of 10, or maybe it's 18%, but the minimum is 10.
And so if somebody is looking to take down a deal, talk to me a little bit about the difference of when should I be considering conventional versus the different types of SBA loans? Maybe you could take us through each of the 3.
Sure. Yeah. So think conventional more when you have a few facilities under your belt. They're all cash flowing really beautifully, and you've got extra money. Like you have enough extra money that you're not going to miss that 30 to 35% that you're going to sink into the next facility. I think about conventional in terms of a
Mhm,
larger owner operator who's getting to like the next level of their
mhm,
portfolio growth. SBA is perfect. You never have to graduate from SBA. So a lot of my really successful customers just keep using the SBA. They end up running out of the SBA runway. Then they'd start to do some conventional refinances and then bring their capital back and keep growing via SBA with the least amount of money down. And I'm sorry, what was the second
mm.
half of that question? Oh, walk you through the three different types of loans.
Yeah, yep.
Okay, so conventionally speaking, most banks are going to be asking for experience. They want to see you've
Mhm,
got some experience. They want to see you've got financial horsepower. They're going to be looking for more liquidity, post-closing liquidity. So after you've put your 30% into the project, they're also going to want to see a fair amount of cash left on your personal balance sheet. The reason the SBA doesn't need that is SBA is providing a guarantee to the bank. So it's guaranteeing in a 7A loan world, 75% of the debt I'm going to give you is guaranteed by the SBA. So that's where we
mhm.
can get a little bit more aggressive with
Yeah,
who are we lending to? Do we feel good, even though they don't have experience, that they're going to make this work? And that's one of the reasons that my credit team loves storage because we have a really high success rate because it
mm,
is it's a simple business.
sure.
So most of these loans are 25 years is appropriate. So if you're out there and your lender's talking to you about a 10-year loan on a piece of commercial real estate, that's not going to be the right fit, more than likely. That's not appropriate, is what I would say. On the conventional side, you'll have a balloon at 5 years. That has nothing to do with your rate. It just strictly means your loan is due in 5 years. So you're going to be forced to either refinance or sell the property at the 5-year mark. Once you move
Mhm,
over into SBA land, it's a 25-year fully amortizing note, meaning you never are forced to do anything with it. No balloon. Fees are a little higher on the SBA side simply because we don't have a balloon payment. So your SBA loan fee, generally speaking, is about 2.6% of the loan. An origination fee on the conventional side, it depends on the lender, but it's typically about 1%. So that sounds like a very, very stark difference. Why is that? The conventional side, you're going to have to pay that fee and all the closing costs every 5 years when you refinance.
mm,
So SBA, you pay that fee up front. It's part of your loan proceeds. It goes straight to the SBA. It's how they fund the program. I'm actually an advocate of the fee because it's not a tax funded program. It's funded by
mm,
those fees. So no matter who is in the White House, nobody is needs to take down the SBA loan program because it's not a tax funded.
mm.
So I happen to like that piece of it. It stings. It's going to sting me when I buy my first facility, but it is how they fund the program.
Sure.
And the program is out there to put money in the hands of small business owners. That is the whole point of the SBA is to keep small
Mhm,
businesses alive. Like we don't all want to turn into Walmart, right?
yeah.
So we've got to, there have to be loan programs out there for people that are looking for this kind of investment.
Hmm.
I can include myself in that bucket.
Yeah,
Yeah.
that's great information. I was going to ask you too, as far as like somebody, what would you encourage folks to come prepared with when they're getting ready to apply for an SBA loan?
It's a good idea to have the easiest thing is have your tax returns at your fingertips. I can't tell you how many times we're in a quick moving situation where we have to execute and get the loan closed within 60 days and someone's CPA
Yeah.
is on vacation. That happens all the time. So get your ducks in a row. The bank's going to want 3 years of tax returns more than likely. It's okay if you haven't filed like at this period in the year. If you have your 25 extension, that's totally fine. But then we need 22, 23, 24. So make sure that should not slow you down. Make sure that you got
Yeah.
those ducks in order. SBA has its own personal financial statement. You can use your own personal financial statement if you're applying to two banks and one's conventional and one's SBA. You can mix and match those two, but make sure you can get into your accounts, find what is the difference between if you have 401k versus IRA versus stocks. Make sure you understand how those work to a bank. In other words,
Yeah.
401k and IRA are considered long-term assets, not liquid assets. Stock and or if you're over the age of 65 and you can access your long-term assets, that is now considered liquidity. So kind of having an idea of where you stand there, being able to fill out a personal financial statement pretty easily is great. I can give you one. I can walk you through that process. It shouldn't be complicated. If
Yeah.
you own businesses, if you have percent ownership in outside businesses, the bank's probably going to want to see those tax returns as well, just to make sure that we're not lending on one business and some business is going to take us down.
Yeah.
The business tax returns. So that's kind of the upfront prep work that I would say is just have you know, make sure you've got everything you need at your fingertips so that you're
Yeah.
not moving the process down.
Yeah. And how, as far as like going through the underwriting, I mean, I'm assuming I haven't done SBAs, but I'm assuming you're going through their underwriting. You guys are also doing your own underwriting as well, correct?
So we will kind of fact check. So we expect someone to give us a business plan that has competition analysis in it. And then we're going to fact check that, make sure like, oh yeah, this is accurate. We look at a rent roll to verify the seller financials. So the rent rolls are really important to us. We're going to count those units up, make sure the income makes sense based on the rent roll. We are looking at trends. When we're looking at seller tax returns, we're really looking at trends. Like if they went from, let's say they went from $43,000 in income a year, and this year on their P&L, they're claiming $70,000 in net income. Or in gross income. We're probably going to ask a question. How'd that happen? What happened
Right.
this? And sometimes there is a truly a legitimate answer, and we're like, okay, that's great. Like sometimes it's just as simple as I haven't been paying attention. I started talking to a broker. They explained to me that I needed to get the facility occupied. And so I spent the last year doing that. Now I'm ready to exit the business, right?
Mm,
But sometimes it's not that case and you want to
right.
protect yourself. Our job is to protect you and the business you're buying. So think about it more like we're or the grandfather even trying to protect you. We're working with you, not
Yeah.
against you. So when we're asking for management summaries and rent rolls and the tax returns from the seller, it's all in an effort to make sure that what you're buying is worth what you're paying. So we take your underwriting of how you're going to run that facility, and that's what we put the biggest emphasis on. So if you tell me it's going to be 20%, I'm going to squint at you and I'm going you to prove to me how you're going to be able to run with an expense margin of 20%, right? I won't say no, but I'm going to probably dig into your business plan a little bit deeper. If
Yeah.
you're in there with like a 30 to 35% expense margin, that is very normal for storage. Hopefully it's not what the seller's doing because this is where your value add is. But we are expecting you to give us how you're going to run the facility, what rates you're going to charge, how you're going to do those rate increases, what your plan is. If it's a 60% occupied facility, that's great. I want you to go buy that deal. But I want you to explain to me how you're going to get it cash flow positive.
Yeah.
You do need, when it comes to like your own due diligence, you do need to have an understanding of how to run a self-storage facility, which is where, obviously storage rebellion comes in, you're going to teach them, what do we need to do here? How do we raise rates? How do we know we can raise rates? How do we
Mhm.
physically do it? Is it going to be automated? Are we kicking everybody out on day one? Please don't
Mhm.
do that, anybody. Don't go do like a huge rate raise and think no one's going to move out because they will.
Yeah, sure.
So kind of knowing the strategies, which we do rely on industry professionals to help teach those items.
And how does it work as far as somebody is going to seller finance a portion of the deal?
So if you can go out and get fully seller financed deal, I'm never going to talk you out of that. I think that's great.
Yeah.
Obviously, you want the rate to be lower than a bank's going to offer you. They tend to be shorter term loans, but I have never seen one that was not refinanceable at the right time. So if you can get a full seller note, go do it. What we see more often is a portion of the debt is carried back by the seller because most sellers want to have an exit. They don't want to
Yeah.
wait 5 years to get all their money. Maybe they want a big payout up front. So on a $1.2 million deal, they may be willing to take $1 million check and hold back 200,000, right?
Mhm.
This is a good thing to keep in mind for people to know. The buyer still has to pay the equity injection of the total project
Mhm.
as part of what they're coming to the table with. Your seller note does not replace your equity requirement. That's
Mm.
a big thing to understand. So, but seller notes still makes sense because you're reducing your loan payment. If I'm
Sure.
charging you 7% and your seller's going to charge you 2% for 2 years at interest only, everybody just won, right? They're going to have
Right.
a tax advantage to that. You're not paying as much to me. No problem. You'd be able to refinance that in a couple years,
Mhm.
most likely even with us.
Yeah.
So, yeah, seller notes are great. We didn't used to see them. That's one of the changes when you talk about kind of if I
Yeah.
look back over the last 7 years, seller notes are definitely something that we're seeing in the last 2 years more
Yeah.
prevalently. It's still not a huge part. I wouldn't say even 80% of our portfolio uses seller notes. You have to have really good negotiating skills to make that happen.
Yeah.
Walk away.
One
Yeah.
of the challenges I think folks run into is that exactly. But no, I appreciate your advice. Have you, like, over the years, have you seen deals go sideways? And if so, what specifically caused that? Maybe some things for people to keep in mind as they're going into this process to make sure they avoid.
So on the construction side, number one thing that derails construction is a bad GC. We
Mhm.
have had some instances where we've had to replace GCs. That is a very timely, costly if your construction takes 2 years instead of 1 year, you can imagine how much more money that costs. So GC, I would say there, we have seen this was tough, but we did do anybody that built maybe 4 years ago can be having stress in their lease up stage. Nobody could
Mhm.
have anticipated that. It's just a market cycle. So if that's not you, then I don't even think you need to be worried about that. But we have seen some deals that the market was really, really strong during COVID and right after COVID. And then it has softened, of course. If your feasibility study was based on that kind of crazy time, you may be facing some struggle with your lease up. On the acquisition side, quite honestly, we don't see this very often, but if a business is failing on the acquisition side, it is majority owner operator problem.
Mm.
So that I know that sounds kind of negative, but
Yeah.
again, if you take your eyes off the prize, if you treat
Sure.
this facility like it's just your little ATM machine, that can be a situation where it's not going to thrive.
Mhm.
So being a good owner operator, paying attention, even if you have third party management in place, that's great, but you should understand what they're doing. What
Yeah.
if they're driving your business into the ground and you don't even know it?
Sure.
So I would say that's the biggest challenge that we can see in our acquisition portfolio is just the owners not treating
Yeah.
it.
I've definitely seen that happen quite a few times, and I think I've seen it more so, and maybe you as well, like during 2022, 23, when, like, we kinda got this boom into self-storage and everybody was buying everything, and a lot of those deals went sideways, and I think a majority of the reason was they didn't know what they were doing, they weren't really treating it like a business. I think everyone thought storage was this attractive, get-rich-quick thing, and a lot of people got themselves in trouble.
Yes, I totally agree with that. And I'll say this too, there are a lot of loans right now that are maybe coming out of a 3 or 5-year fixed rate. So their rate is resetting to new normal. And that is something, again, nobody can control. The hope is you can refinance or your lender will do a rate modification for you to put you back in sort of a more appropriate rate
Mhm.
if your rate is outsized for the amount of equity you have and how strong the project is. If you're
Yeah.
not doing well and you're at a low rate and then your rate changes into a high rate, that's obviously going to be negative.
Yeah. Yeah,
But
for sure.
we don't see that very often, truthfully.
Yeah.
And again, if I had to point at what's the real problem, it's that you're probably not a great operator. Because if you can't operate a facility at a
Right.
3.25 rate, I can't save you.
Yeah, right. No, exactly. So know what you're doing when you when you decide to invest, especially when you're using someone else's money. And one of the things I want to talk to you about as well, because I know a lot of people who are getting into storage will primarily focus on seller financing, private money, conventional loans. And I know there was kind of like this time where people weren't paying enough attention to SBA loans. And I was wondering if maybe this was an area you can kind of touch on, if there were one or two biggest misconceptions
Sure.
that you've come across.
Sure. So the first thing I would say is don't be afraid to take on debt. When
Hmm.
I talk to my 40 million net worth self-storage owners, and I'm being very honest with you, these are real conversations I'm having with people across the country that have owned storage for 20 years. Those people all have debt. They all have bank debt. You don't grow a portfolio with your W-2 income. You grow a
Yeah,
portfolio using other people's money. So don't be afraid of debt. You wanna be smart about your debt. You wanna constantly be looking at what your IRR is on the facility, on the debt that you're taking on. You wanna be smart about it, but don't be afraid to take on debt. That's the only way you're gonna be able to grow. Saving cash is really important. So, what I would prefer you to do is put 10% into the loan and sit on some cash so that I, as the lender, have some comfort that if something goes bump in the night, if we have some other crisis that no one saw coming, and half your population moves out of your facility, I still want you to be able to make those payments. So cash makes a lender feel really comfortable, cash
sure.
sitting on a balance sheet versus cash that you're sinking into a facility. So don't be afraid to take on debt. Don't be afraid to take on high leverage debt. It really can make a huge change in your life if you can get some high leverage loans. You don't have to hold it forever. You'll be able to hopefully do a cash out refi in maybe under 5 years, pull some of that cash back out, come back and do it again. So that would be the number one thing as far as myth goes. SBA has a bad, well, I hope Live Oak should have come a long way since 2007 in bringing the SBA kind of alive again for the American population. It is
Yeah.
historically a longer loan to get and it's paperwork intense, but the value of it is massive.
Mhm.
Don't have to have experience, 10% into the deal. Working with a lender that's a SBA approved lender means they have they're using their own capital, they're making their own credit decisions. They're not going to the SBA to ask permission. That's really important in your process. If your lender doesn't understand SBA, please go run away because that's not going to be successful for you. You could be in closing because they're trying to figure out the SOP. So, this is Live Oak's focus. This is how our bank started is niche lending. We know the SOP inside and out. Every time there's a pivot or a change, we're the first ones usually to hear about it. Oh, well, not to hear about it, but to like fully digest it and change our own policies around it.
Sure.
To ask about myths. So another thing I like for my customers to understand is when you're buying an acquisition, 6 years
Mhm.
ago, you would have been looking at seller financials and your 10% leverage loan. So I'm giving you 90% there. And you might have been at a 1.25 debt service coverage based on historic seller cash flow. That is not
Mhm.
today's acquisition. When I go to buy a facility myself, I am not expecting that to be the case. If somebody had that, I promise you that broker would buy it themselves. Okay. So here's what I want you to know. When you come to Live Oak, I can't speak for other lenders, but we are expecting to lend you money based on how you're going to run that facility in the future. I don't want you to overpay. I see this a lot. I don't want you to overpay for this facility. You should not be paying for net income that isn't there.
Mm.
However, if you're buying a 60% occupied facility, they haven't raised rates in a long time and their expenses are sort of sloppy, don't overpay for that. And I'm going to lend you money based on how you tell me you're going to run that facility. If you can show me you're going to hit 1.25 kind of in the beginning of year two, or even in the middle of year two, we can get behind that. So we want to
Yeah.
know what your plan is. We want you to have a good, solid plan. Don't tell me if your neighbor down the street has a nicer facility and they're renting for $100 a unit and you're telling me you're going to rent for 120 and yours isn't as nice. So
Sure.
come with a good plan. But point here is we are basing most of our acquisition decisions on projections, not in place.
Mhm. Yeah. That's helpful information. I know one thing that came to mind actually as you were kind of talking about some of this, and you already previously talked about it, so I apologize. I'm kind of backing up. But you had mentioned as far as maybe more risk and deals going potentially sideways. Sounds like the lease up, the ground up. How are you guys looking at those opportunities? If somebody comes to you and they want to do an SBA and it's a new construction, how much more intense is the application process, or is it somewhat the same?
It's pretty much the same. The
Okay.
difference is I can do a loan if let's just say person A comes to me, I can approve them for a construction loan as easily as I can approve them for an acquisition loan.
Mhm,
We're gonna capitalize the construction loan such that it will pay for this business until the business can pay for itself. Now,
mhm.
how do we trust that that's gonna happen? We we require a feasibility study from an unaffiliated third party, so someone that we know and trust, and they provide
Yeah,
projections for a ground up construction deal. You may say, "I've been doing, self-storage project I own 10 facilities and I've been doing this my whole life. I know what I'm doing. I'm gonna give you the projections myself." I'm still gonna say no because everybody thinks their baby's beautiful. So, we require a feasibility study. If you're adding on to your own facility and you're not more than doubling the footprint, probably not gonna need a feasibility study. If you own storage and you're building something down the street and it's not again, you're not doubling the footprint, I don't need one. Those are cases where
got
we can take your projections. But the only difference between an acquisition and a construction loan is before we close your construction loan, you need to have your permits in hand because we don't want you to
you.
burn through your construction period not under construction or excuse me, through your interest only period. And then we need to get the loan approved, we need a budget. So I need you to give me your hard and soft costs. So soft costs are what's it going to take to get permitted? Architectural engineering, civil, city fees, DOT, that list can be very long. Those are soft costs. I need your hard costs from a GC. And then I marry that up with your projections. I put in all the working capital that you're going to need. And then I'm looking at debt service coverage just like I do on an acquisition. And we do construction loans all day long with 10 and 15% down depending on the loan product.
Yeah, no,
Pretty
I appreciate you.
and we do construction loans for people that don't have experience.
Okay,
Mhm. You don't have to have experience. I mean, I certainly want to believe in you. I wanna know that you're doing the diligence,
sure.
but, as people talk about, it's not a crazy business to run. We do care who your GC is. We wanna make sure you have
Yeah,
a
yeah, yeah.
qualified GC. We put the GCs through a qualification process, but we're here for the small business owner we're willing to take a chance on you.
Yeah, that's
Mhm.
awesome. And this
Mhm.
has been extremely helpful and just great information all around. I think this is one of the topics that a lot of people don't know too much about. Certainly, some of the experienced investors who have used SBAs multiple times and have done a lot of conventional loans, things like that, they get it. But there's a lot of folks coming into this space. They're working on maybe their first, second, or third deal. They haven't dug into this enough. And so I think this is going to be a helpful episode for them. Before we go, what's the last biggest piece of advice you think you'd like to leave people with?
We can do 100% financing. So, I know that sounds really exciting, and it sounds like maybe it's not true. Maybe that's a myth. I'm here to tell you I do it every day for my customers. I just talked to a repeat customer. He's been with me for 5 years, and he's come back with an acquisition, and I
Yeah.
said, "I can do 100% financing for you." And he got so excited. He's like, "And I don't have to get partners. I don't have to dilute my ownership." He was so excited.
Yeah.
So, okay, here's how it works. The business you own, so you have to own a storage already. You have to have owned it
Mhm.
for at least 12 months. It needs to be cash flow positive, so like 1.25 debt service coverage. Your ownership for the new facility that you're trying to buy with 100% financing has to match 100% identically. '05 ownership cannot change. So if you had 3 investors in your first facility, to get 100% financing, you have to have those same exact investors at the same exact amount.
Okay.
Mhm. But this is where it's good to know this up front because if you take a chance and give me all of what you had intended to invest, if you spend it all on your first property, as long as you save cash, and you've got cash there, when you come back to do the second loan, I can do 100% for you. And now you don't have partners, you haven't diluted your ownership interest. Hopefully you're sitting on some cash. I'm not going to take that cash from you. I want you to keep that
Yeah.
cash, but I trust you and I'm going to do another loan for you 100%. And those are the rules of the road. The idea from the SBA is it's an expansion of an existing facility. So your equity exists in the facility you own. They want to
Mm,
see that you're sharing resources. So you're sharing a brand, you're sharing your marketing resources, your management plan is. So you're having an economy of scale. So that
yeah.
makes sense. And people ask me a lot, like, how far away can it be? It needs to be reasonable to think that you're, creating some brand awareness, but can it be in a
Sure.
different state? Yes. Does the SBA actually have a geographic limit in the SOP? No. So call me and we'll talk about it and see if if you're checking all the boxes that I just talked about, we're probably gonna be able to do it. You don't already have to have an SBA loan either. You can
Okay.
come to me with debt in place that's non-SBA, and I can still use this expansion rule and do 100% financing via the SBA loan program.
Gotcha. Speaking of, having some cash to sit on, you had mentioned this at the event we just did, but if you're looking to scale your portfolio, and I'll let you touch on it quickly, as you're
Yeah.
looking to scale, don't go out and buy the RV or the boathouse or whatever it might
Don't go run and
sit
put the
on that
pool in.
cash.
So what happens with some of my customers that get really excited, they've got, they have their W-2 income. Now they've got the storage that's producing some extra income for them. And they come back to me, they're ready to do their next loan. Even if I'm going to do 100% financing, I need to see that you've got a little small pot of gold sitting somewhere in a bank account because we're taking a risk on you. If something goes bump in the night that was completely unintended, we need to know that your knee-jerk reaction is not, "Oh my gosh, to file for bankruptcy." So my best
Yeah.
advice is save, save, save your cash. Don't, you know, run out and put a pool in, buy the RV, take the family to the $26,000 vacation in Disney. Please don't do any of that. Just
Yeah.
be patient. There is gonna be a day where you get to just have fun and spend your money however you wanna spend it. But as you're building a portfolio using bank financing, I want you to just self-control. It's gonna take you further faster. I promise you. If
Yeah.
you come to me, there's not really an amount that I'm looking for. When you call me and I look at your personal financial statement and how much you're trying to borrow, I'll tell you what that amount is. But cash is king. It's really important. Even if I'm not putting it into your project, I want to know that you have it.
Yeah.
Very, very critical.
Yeah. Makes sense. And thank you so much for being here. Lastly, how can people get in touch with you?
Email is the best way. I'm on the road a lot. So typically if you email me, I'll write you back immediately and schedule a call. So it's Anne, ANNE .mino, MINO at live oak, like the tree, .bank. And that's the part that people usually get confused about. It's live oak .bank. We have our own server that's secure.
And thank you so much. Looking forward to connecting again soon and also seeing you in Austin coming up in a few months.
I can't wait. Thank you so much.
Thanks for listening to the Storage Rebellion Show. For resources, support, and a community that has your back, visit storagerebel.com. We'll see you next time.